If you search how to pay less taxes in retirement, right now you're going to get 3 answers. Maximize your RRSP, downsize your home, start a small business. And honestly, none of those answers are wrong. But for someone between 55 and 65, following that advice without running the full numbers can cost you more than it saves. Here's the number that changes everything: $95,323. That's the 2026 OAS clawback threshold, the income level where the government starts taking back 15 cents of every dollar of your old age security. Most people don't know they're close to it until the T1 comes back and the damage is already done. The 3 strategies work, but each one has a hidden second act that the standard advice never covers. Your RRSP contribution gives you a refund today, and a tax bill in your 70s when your RRIF starts forcing withdrawals. Your home sale is tax-free, but the proceeds don't stay tax-free when you invest them. Your consulting income looks like a win until the CRA decides your corporation doesn't qualify for the small business deduction and taxes you at the top rate instead. I'm going to walk through each one, show you the actual math, and tell you what to do differently so you keep more of what you've earned. First up, the one everyone swears by: RRSP contributions. Let's run the numbers on a common scenario. You're 60 years old, still working, and your income is $90,000. You put $10,000 into your RRSP. At a 30% marginal tax rate, that's a $3,000 refund. Clean, simple, feels great. Now fast forward to age 72. Your RRSP has converted to a RRIF, and the government requires a minimum withdrawal every year, a percentage that increases as you age. If your RRIF throws off $10,000 that year, on top of your CPP and OAS, and your combined income crosses $95,323, you've just entered the clawback zone. The government recovers 15 cents on every dollar above that line. On a $10,000 excess, that's $1,500 of your OAS gone. So the $3,000 you saved at 60 nets you $1,500 after the clawback math, not because the RRSP was a bad idea, but because the withdrawal timing was never part of the original advice. This isn't a rare edge case. The 2026 RRSP contribution limit is $33,810, which is 18% of prior year earned income. A lot of people close to retirement are making significant contributions right now, and most of them haven't mapped out what those balances mean in mandatory RRIF withdrawals 10 or 15 years from now. You paid into that RRSP your whole working life. Nobody told you that the withdrawal side of the equation could quietly cancel out part of the tax savings you counted on. So what actually works? The RRSP is still a good tool, but the timing of contributions matters, and so does the order you draw from your accounts later. In years when your income is already high, TFSA withdrawals don't add a single dollar to your taxable income. RRIF withdrawals do. That difference determines whether you stay under the clawback line or not. If you're in your late 50s and your income is high right now, a large RRSP contribution still makes sense, but your withdrawal strategy needs to be planned alongside it, not figured out later. Think of it as 2 sides of the same decision. The deduction today is only worth what you keep after the withdrawal tax tomorrow. One more thing worth naming: some people in this range have enough TFSA room to shift where their retirement income comes from. The cumulative TFSA room since 2009 is now approximately $109,000 if you've been eligible and never contributed. That's a substantial tax-free bucket. Keeping that full and drawing from it first in high-income years can make a real difference on where your net income lands versus that $95,323 line. If you're wondering whether your own RRSP is a trap or a tool, I cover the exact withdrawal sequencing in other videos on this channel. Subscribe to the playbook so you can see the full picture. So the RRSP isn't broken. The strategy is just incomplete without the decumulation plan attached to it. That leads us to strategy 2, which sounds like the ultimate tax-free move, selling your home. The principal residence exemption is one of the best tax rules in Canada. When you sell the home you've lived in, the capital gain is tax-free. No other investment gets that treatment. So when people hear sell the big house, pocket the difference tax-free, and fund your retirement, that makes complete sense on its face. Here's where the hidden math hits. Say you sell your home in Mississauga for $1,200,000, buy a condo for $700,000, and free up $500,000 in equity. That transaction is clean, no tax owed, but now you have $500,000 sitting in cash. The natural move is to invest it. At a modest 5% return, that's $25,000 a year in investment income. And investment income, whether it's interest, dividends, or capital gains, is not sheltered. It shows up on your tax return as income. Now add that to what you're already collecting. CPP at 65 averages around $11,100 a year for new recipients in 2026, though amounts vary significantly by contribution history. OAS at 65 runs roughly $8,200. If you're also drawing $15,000 from your RRIF, you're looking at total income around $59,500, still below the $95,323 clawback line. Safe for now. But here's the part that gets people 5 to 10 years later. Investment accounts grow. RRIF withdrawal minimums increase with age. If that $500,000 in a non-registered account is generating $40,000 by the time you're 72, because markets had a few good years, or you switch to higher yielding assets, and your RRIF minimum is now $25,000, and CPP and OAS haven't changed, you're suddenly at $88,700 or more. One more decent year from the portfolio, and you've crossed the line. The OAS clawback kicks in, and you're losing $3,000 to $6,000 a year that you expected to keep. I'll be honest, for a long time, I thought downsizing was the automatic answer for anyone trying to simplify their retirement. It took me sitting down and actually running the year-by-year income projections, not just the sale day math, but what those invested proceeds look like at age 70, 72, 75, to see that the conventional framing completely ignores the multi-year income effect. I don't know every detail of your situation, but I know that selling the house and investing the proceeds without a plan for where that income lands is one of the most common and least discussed traps out there. So what does the better path look like? If you're downsizing, think carefully about where the freed up money goes. The TFSA can absorb $7,000 a year, not the whole $500,000 at once, but methodically over time. Proceeds that go into paying down any remaining debt don't generate taxable income at all. And keeping some of it in the new property itself, buying a nicer condo instead of the cheapest option, is a perfectly reasonable way to hold equity in a tax-sheltered form, since the principal residence exemption still applies. The fragile path is sell, invest everything in a non-registered account, assume the income will stay manageable, and never revisit the projection. The resilient path is sell, hold what you can in tax-sheltered accounts, plan what the taxable portion produces in income, and check it against the $95,323 line every year. The sale is tax-free. What you do with the money afterward is not. And for someone already collecting CPP and OAS, that distinction is worth thousands of dollars a year. So if the standard two strategies, RRSP and downsizing, both have hidden downsides that nobody mentions up front, what about strategy 3? Starting that retirement consulting business. That one's different, right? Well, here's where the CRA gets very specific. More and more Canadians over 55 are picking up consulting work after they leave their primary careers. $15,000 to $30,000 a year on top of their pension income, staying relevant, keeping active, earning a bit more. And the first thing a lot of people think when they start that up is, should I incorporate? If I set up a corporation, I can access the small business deduction, 9% federal tax on the first $500,000 of active business income. Compared to paying personal income tax, that sounds like a serious win. But the CRA has a specific rule designed exactly for this situation. The Personal Service Business Rules. Here's how it works. If you're operating through a corporation, working for one primary client, doing what an employee would essentially do, and you wouldn't be considered an independent contractor if the corporation didn't exist, the CRA can classify you as a personal service business. When that happens, the small business deduction disappears. Your corporation gets taxed at the top personal marginal rate. In Ontario, that combined federal and provincial rate is roughly 53%. You pay corporate tax at that rate, then personal tax again when you pull dividends out. The income cannot be split, most business expenses are restricted, and the administrative costs of running a corporation, tax filings, corporate maintenance, come on top of that. Contrast that with operating as a sole proprietor. You earn $25,000 consulting. You deduct your home office costs, a portion of your phone and internet, any supplies or transportation that was genuinely business related. Let's say those deductions total $3,000. Your taxable net is $22,000. At roughly a 25% marginal rate, you owe about $5,500 in tax, plus CPP contributions on that self-employment income of around $3,200. Total tax cost roughly $8,700. You keep about $16,000. Clean, simple, and you're not paying a corporate lawyer or an accountant for a T2 filing. Try this at home, pull your last tax return, add up your expected retirement income sources, and see how close you already are to $95,323. Then add in what a consulting income of $20,000 or $25,000 would do to that number. You might be surprised how quickly the math shifts. The 4 things worth knowing if you're starting retirement consulting work: stay a sole proprietor unless you have 3 or more unrelated clients, genuine business overhead over $50,000 a year, and real financial risk if a contract falls through. Claim the home office deduction using the detailed method. Track your actual workspace costs and calculate the business use percentage of your home expenses. Use the earned income from consulting to generate new RRSP contribution room. 18% of self-employment earnings creates future withdrawal flexibility. And keep your total income in sight of the clawback threshold. If you can stay under $80,000, you have a comfortable buffer. The incorporation instinct makes sense if you're building a real business. For a retiree doing one consulting contract at a time, it's usually the wrong tool. The CRA's personal service business rules are there specifically to prevent that structure from working the way people expect it to. So the 3 strategies work, but only when you understand the full chain of consequences. Don't just follow the surface level advice. Now let me show you what actually happens when you do. There's a reason this incomplete advice keeps circulating. It's called action bias. The instinct that doing something is better than doing nothing, especially when money is involved and the clock is ticking. You hear RRSP refund equals free money, and it feels like a win. You hear principal residence exemption, tax-free gain, and you feel smart. The brain gravitates toward the clear, clean story, not the one with the asterisk. And it's not just psychology. Every major financial institution promotes exactly these 3 strategies. They're not lying. They're just stopping at the first chapter. The full picture requires running scenarios across 20 plus years of retirement income. And most people don't get that conversation unless they go looking for it. There's nothing wrong with you for not knowing the second chapter. I don't know every detail of your situation, but I know that the patterns show up consistently, and the people who get caught by the OAS clawback or the personal service business reclassification are not naive. They followed advice that was genuinely good in isolation. One small shift changes a lot. Instead of asking, what saves me the most tax today, start asking, how does this affect my income across the next 20 years? From refund now to income stream later. That single reframe is the difference between a strategy that works on a spreadsheet in 2026 and one that still works when you're 75. So here's the bottom line on all three. 3 strategies, 3 rules. Strategy 1, yes, use your RRSP, but plan the withdrawal side before you make the contribution. In years when your income is already high, pull from your TFSA first. That keeps your net income below the $95,323 clawback line and protects your OAS Strategy 2. Downsizing is a smart move for freeing up cash, but where the money lands after the sale is what determines whether it helps or hurts. Keep proceeds in tax-sheltered accounts or use them to pay down debt. Don't let a tax-free sale generate a taxable income problem. Strategy 3. If you start consulting work in retirement, stay a sole proprietor unless you genuinely have multiple clients and real business overhead. The CRA's personal service business rules will cost you far more than incorporation saves if you don't meet the threshold. If you're a Canadian between 55 and 65 and you want to stop guessing about these retirement tax traps, if you want to protect your OAS, keep your TFSA working, and handle your income the right way, subscribe to Brian's Canadian Retirement Playbook. I go through the actual numbers so you don't have to. You've earned your benefits. Let's make sure you keep them.